Hello Rebels, this is a recap of week 7 of Rebel Finance School 2023. This is not a replacement for watching the video in full, this is just a quick recap to refresh your memory as to what we covered.
If you've not watched it, go back and watch it. Right, recap. Week 7 we covered 4 things.
Yeah.
Number 1.
Fees, the silent killer.
Number 2.
The stock market roller coaster.
Number 3.
How to lose money in the stock market.
Number 4.
Common questions about index funds.
So let's go to the first. Fees, they absolutely kill you. Over the long run, fees kill you. And we had this example of early Ellie and how she could invest through a high fee broker, such as St James's Place or Wealthify or some other thing like that. We actually used the numbers from your first investment, didn't we?
Boo.
And then we had how she would end up if she just invested in Vanguard. And the difference was
£154,741. Difference between active investing with high fees and passive investing with a Vanguard low-cost index fund.
So would you rather have the money, or would you rather your advisor has the money? But it's only 1%.
Oh, you get this all the time, but the power of compounding when it works for you, and then if it's slowly taking out 1%, as you saw on that previous graph, it makes such a difference over the long term.
Keep the 1%. So how much does it actually cost to invest? Katie has created a fees tool at alandonegan.com/fees where you can go and type in your fees from your current investments and compare it to Vanguard. It's auto set up, scan the QR code, do it now.
Next part, we talked about the roller coaster of the stock market. Laura in the middle looks like she's having fun, which is good because expect a roller coaster. That's the whole point. The stock market will crash. Just be prepared and choose how you're going to react when that happens.
A crash is like a 20% drop and it happens on average every 8 years. So it is coming.
So doesn't that mean that investing in the stock market is really risky, Alan?
Well, it is. On average, the market goes down 1 in every 3 years. But over the long run, the market always goes up, and that's what we are playing the game for.
Decades and decades and decades, buy and hold and keep forever.
Exactly. So time in the market is more important than timing the market. That's the most important thing.
Meaning put the money in, forget about it, go about and live your life rather than thinking it's too high, it's too low, what shall I do? Just get on with it. So what should we do when the stock market crashes, Anna? Should we do this and panic
like everyone else?
Or should we reframe and say stocks are on sale?
Exactly. So we check down the bottom of the sofa, try and find some extra money and buy some more stocks when it crashes rather than panicking. So number 3, how to lose money in the stock market.
And this is a how-to guide as to how to avoid it rather than encouraging you to do these things.
We teach you how to do it so you can avoid it. Yes. The main one was panic sell when the market crashes. People get very fearful and then they destroy their financial future with stupid decisions.
Not good. The next one, to lose money, is think you're more intelligent than the market. Try and buy individual stocks, individual shares. Don't do that. No one is cleverer than the market.
Or think someone else is cleverer than the market.
Exactly, with a fund manager.
Take a fund manager like St James's Place and think they can beat the market, obviously.
Don't bother doing that. Just get average returns, which is average of all the companies in the market, and over the long term you will be incredibly wealthy.
Which is actually the top percentiles. Move on. Never kill the Golden Goose. Never ever sell those investments. The Golden Goose own the stocks and shares, and then over the years they will produce incredible returns for you.
Long-term strategy, decades and decades and decades. What else did we have? We had common questions about index funds, and people always come to us and they say, I've got all this money, I've got a lump sum, maybe I've got some inheritance or just sold a house or something like that. What do I do with it? Should I put it in one go or should I drip it in the market over time?
The answer is just put it all in one go. It wins nearly all of the time. Just get on with it. We covered lots of the questions. We can't cover them all now in this recap video. So moving on, that was week 7, index investing and long-term wealth in 4 minutes. Thank you for listening. If you haven't watched the full video, watch the full video. There's stuff we cannot fit in there. So go and watch it. And thank you for being part of Rebel Finance School.
See you next week.